Disclaimer: this video is created for educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. Most people know ETFs are a great way to invest, but very few truly understand how they actually make money. You buy an ETF, you see the price go up or down, and that's it, right? Not exactly. Behind that simple chart on your investing app are several powerful mechanisms quietly working to grow your wealth. In this video, we'll break down exactly how ETFs make you money, through price appreciation, dividends, and reinvestment, and why they've become one of the most powerful, long-term tools in modern investing. Let's start with the basics. An ETF, or exchange-traded fund, is like a big basket that holds many different investments. Stocks, bonds, commodities, or even other funds. When you buy a share of an ETF, you're essentially buying a small piece of everything inside that basket. So if that ETF tracks the S&P 500, you instantly own tiny pieces of the 500 biggest companies in the US, from Apple and Microsoft to Coca-Cola and Amazon. Now, those companies, and the ETF itself, have multiple ways of generating returns. The first and most obvious one is capital appreciation, which simply means the ETF's price goes up over time. Let's say you invest $100 in an ETF that tracks the S&P 500. If the market grows 10% that year, your $100 becomes $110. That $10 profit is your capital gain. It happens because the companies inside the ETF have grown in value, and the ETF share price reflects that growth. The beauty of ETFs is that your performance doesn't depend on one company doing well. You're spreading your risk across hundreds or even thousands of companies. Some will rise, some will fall, but historically, the overall market tends to grow. That's the power of diversification. But ETFs don't just rely on prices going up. Many of them also pay you directly through something called dividends. When the companies inside your ETF earn profits, some of them share those profits with shareholders. If you hold a dividend-paying ETF, those payments are passed along to you, usually every 3 months. So even if the market is flat or down, you can still receive regular cash flow just for holding your investment. Bond ETFs work in a similar way, except instead of dividends, they pay interest from the bonds they hold. Now, what most new investors don't realize is that these small payments can make a huge difference, especially when you reinvest them. That's where the real magic happens. Instead of taking your dividend cash out to spend it, you use it to buy more ETF shares. That means next time dividends are paid, you'll receive a little more, because you own more shares. Then you reinvest those too, and the cycle continues. This is called compounding, and it's one of the most powerful forces in finance. Over years or decades, compounding can turn small, consistent investments into significant wealth, even if you never add more money yourself. Many brokers offer automatic dividend reinvestment plans, so the whole process happens in the background without you having to do anything. Another major reason ETFs help you grow wealth faster is that they're incredibly cheap to own. Traditional mutual funds often charge high management fees, sometimes 1% or more per year. ETFs, on the other hand, are mostly passively managed, meaning they simply follow an index like the S&P 500 or the MSCI World. Because there's no team of analysts constantly buying and selling inside the fund, the costs are much lower, often as little as 0.05%. And while that difference might sound small, over 20 or 30 years, it can mean thousands or even tens of thousands of dollars more staying in your pocket. In other words, ETFs let your money work harder for you because less of it is eaten up by fees. When you combine all these elements, growth from rising prices, cash from dividends, and efficiency from low costs, you get what's known as your total return. That's the true measure of how much your ETF investment is earning you. For example, an ETF might only go up 7% in price, but if it also pays a 2% dividend, your total return is 9%. That's what long-term investors really focus on. Not just price charts, but total wealth growth. There is another advantage that often goes unnoticed. ETFs are generally more tax efficient than other types of funds. Because of how they're structured, they don't have to sell investments inside the fund every time someone buys or sells ETF shares. That means they trigger fewer taxable events, allowing your gains to grow untouched until you actually decide to sell. And when you do sell, you pay taxes only on the profits you've made. That gives you more control over when and how much you pay, which is another small edge that compounds over time. When you step back, it's easy to see why ETFs have become one of the most popular ways to invest in the world. They let you grow your money through appreciation, earn income through dividends, and maximize that growth through reinvestment, all while keeping costs and taxes low. They don't promise overnight riches or risky bets. Instead, they build wealth quietly and steadily in the background, letting your money grow while you focus on living your life. That's the real secret behind how ETFs make you money. It's not about timing the market or chasing trends. It's about staying invested, reinvesting your earnings, and letting time do the heavy lifting. If this video helped you understand ETFs better, don't forget to like it and share it with a friend who's starting their investing journey. Comment below and tell us. Do you prefer dividend ETFs or growth ETFs? And of course, make sure you subscribe to Money Mindset and turn on notifications, because we post new videos every day to help you build smarter money habits and make finance simple.